Good evening, Nick and Min from VolumeProfileTrader.com on Saturday, June 23rd, and talking about the market here. You know, this is the thing. What we saw midweek on Thursday when the market took a tumble is we defined our ceiling in the market, and hopefully, going into either the 20th, which was Wednesday, or early Thursday morning, maybe you got a few short setups to the downside, and hopefully, of course, given the way the market performed on Thursday and Friday, those shorts were rewarded. So, right now in the market, I'm still looking at this 1300 to 1320 level or so. We basically got down there on Thursday, Friday. We saw a little bit of a bounce, but this is my major pivot on this daily time frame. If we drop below this, I suspect that we'll drop. My first target would be 1242 or so, just the bottom of this range. You can see the volume sticking out. But other than that, we could easily get down to this 1200 level, let's call it, down to 1180 or so. And you need to be aware of that, because the most important volume right here, right now in the market on a 1 year chart is basically where price currently is. So we're going to see a meaningful move off of these levels. It's just choppy right now, and you shouldn't over leverage yourself one way or the other, whether it be long or short, because sure, the market, it's going to break one way or the other, and let's say you are piled in on the long side and the market goes up. Well, you feel like a genius for buying this dip and, claiming you knew it was going to go higher. You didn't know that. You guessed, or you placed, your bets to the long side and it paid off. But if it didn't, and the market slid below 1300 and then got, a slippery slope down to 1250, maybe even down to 1200, then you're thinking that, trading's rigged, and, there you go, losing half of your portfolio's value because you were over leveraged to the long side. Please realize that there's no telling which way this market's going to go. You can make an argument for either way, and the most important thing is when you get short setups, you take them. When you get long setups, you take them. Naturally, if you are hedging your portfolio correctly, if you are managing your portfolio correctly, especially with the use of stops, you will naturally be stopped out of shorts. Whether you're trailing your stop, whether you're taking, a loss or break even, whatever, if your stops are in place, you will go from, let's say the market rallies and you have half shorts, half longs, and the market's starting to break out above these recent highs. And let's say you have all your shorts, to be stopped out above this swing high. Well, there's nothing wrong with that. You're managing risk. But what it's going to do is put you in a position where the market rallies, and then once, you'll get stopped out of your shorts, so you'll automatically raise cash. Your longs will continue to work, and then on the first pullback, the idea is you put more of that money that you got stopped out with to work in the, riding the trend higher. So I hope that kind of clicks some, but it's just a matter of managing your risk if you're in a long short situation. Now, if you're a day trader, or maybe a long only swing trader, which I don't necessarily recommend, day trading, we'll focus on that. Let's say you just day trade the S&P futures. You're going to be put in a situation where you don't care which way the market goes. You just want volatility on any given day. And therefore, if it drops below 1300, you can probably stick with the thesis that you want to be, for bigger daily wins, you want to be selling, into an overall downtrend. Likewise, in an uptrend, you want to be buying any major weakness, relative to a support level. So, overall, I don't really have an opinion of the market other than Thursday is a pivot. And if we see names like Freeport recover, which it doesn't look like it relative to what the last 2 days showed us, then maybe you have a case to have a bias to the long side. But based on Freeport, just bringing up a few more, Tech Resources, Baker Hughes, these are all names that have just continue to take a beating and show you that the overall weakness is still there. Now you can look at a name like Starbucks, which is hanging in there with gas prices coming down, already a great company. Coca-Cola kind of looks toppy, really. Could easily see a reversion back to the 200. But names like them, like these, are hanging in there versus names like Freeport and Baker Hughes. They're having trouble, and you need to be aware of that. You need to realize what type of business they are, and if your fundamental thesis matches the technicals, then that gives you the case to stay in the trade longer, and use some type of technical trailing stop, or based on swing highs or something along those lines. So one thing I want to show is the dollar. First, on a 2-hour chart, last month's point of control, 81.4290. Where did we bounce 3 times, 4 times in a row the past couple of days? You betcha, at those levels. What happened when the market was hitting those levels, the S&P that is, which should look, slightly inverse. That was bouncing off value area high for the prior month, and we sell off. So it was a pretty good sell signal, realizing the market is still choppy. There is no determined trend. So please stop, thinking that the market is breaking out here. I don't think, it was for a slight move, but here we are one day, and it changes everything. And those shorts took advantage of where that dollar point of control was, and the S&P value area was. So be aware that the shorts are very well a part of this. So let's zoom back in. The only thing I can say about the dollar is definitely in some type of consolidation. We have lower highs and lower lows, but within an overall uptrend. So be aware of that. Realize that it's a little choppy up here. Maybe it breaks up to the upside, maybe the downside. But as long as it holds these lows, I think you'd want to remain some type of buyer on the dollar. Just because the uptrend, this uptrend, is still intact. Another great example of market profile. Last month's point of control on the euro. Look at where resistance is this month. This is what it's about, and this is what you can learn with volume profile. So realize that we are at this month's point of control. If we see more weakness here, given that we're almost at the end of the month, we could see, we can start using intra-month as support resistance levels, especially where the point of control is value area high, value area low. So the fact that, we would need to see some type of bounce back up to 127 on the euro to get, quote unquote, excited about risk on type of things. If not, if we just continue, if we continue to consolidate, we will, in this little range, and we start to fall lower, I would suspect some type of test of these obvious lows here, which isn't too far away. For a day trade, it would be nice. But I would like to see a retest of these lows, see if we can get down there, and that would cause a little bit of panic. Okay, gold. I have to go back 2 months just because of how the profile is set up. We have, from last month, we had a big high volume here right where the value area is. I'm sorry, not where the value area is, because I have that blue line. Just a big high volume area here, and really below that, just light volume. Above that, you have resistance from the, or I should say volume from the prior month. Looking at the point of control from the prior month, April, the exact number is 1645, sorry. And then, coincidentally, the high so far of this month is around 642. Then we had our lower high. This is where I was, playing the short side of gold, and it slammed lower. So it slammed as far as last month's point of control. We're seeing a little bit of a bounce here. Maybe this is starting to click some how accurate these numbers can be and use them to your advantage. Oil, now look at oil. Oil is in a steady downtrend. It's tough to use the monthlies because the oil market keeps trending to the downside, and there's been no retest of these profiles. For example, the profile of May, it only at the lows was price touched and then rejected. This high volume area here on May, price got into it, let me zoom in some, and rejected twice. So that needs, well, really 3 times. That needs to be taken account for. So what I'll do is I'll bring it into a 30-minute chart. Well, 20-day, we'll do 1 hour. Look, and these are weekly profiles. So looking at last week's, be aware of the value area on oil for last week, and then look up to these this bounce area that we've seen oil bounce from, and then it broke down from 82.50 or so, and then to the upside. Last week's point of control, 84.13. Look at the top end of this range, this high volume area here. Try to stay focused on last week's profile, realizing that the ultimate test would be around 84 to the upside, realizing 82.50 could be some type of resistance, but on the way up, your ultimate target would be 84 or so. I'm sorry, 84.15 on oil. So really, that's all I have to say. If you're having trouble with individual names, stick with the S&P. It's volatile enough to make money right now. Swing trading, day trading, we have these 2 to 3 day swings. Actually, that long lasted, a week or so. But, be opportunistic. And when you get your setup, take it. And, hopefully members who have signed up for the trading course, the entry methods that we've shown have proven to be effective for you to make some money and to capitalize on these levels that you're trying to trade off of. So, anyways, take care, have a good night, and I'll talk to you Monday.